Okay, so this is for your Chapter 12 handout on interest. I'm going to walk you through 4 different scenarios on how to calculate interest. So we'll start with number 1, and I'm going to go ahead and turn on my stylus so I can go ahead and do some annotating. So number 1, we've got, it says notes receivable has a balance of $9,000. I'm going to go ahead and circle that. It says assume that the note represents funds loaned on October 1st of the current year and will be received back within 6 months. The annual interest rate is 12%. So remember that everything in this chapter on interest is going to be calculated by taking the principal times rate times time. Principal times rate times time. So in this problem, the principal is going to be $9,000. The interest rate is going to be 12%. And if you recall from my other illustration, I always take that interest rate, which I'll put it in decimal form as 0.12, and I divide it by 12. So what that does is that converts it into a per month interest rate, which in this case is going to be 1% per month. T is for time. Time period in this particular part of the problem is going to be October 1st through December 31st. So that's going to be what, 3 months? If you multiply all that out, you're going to get $270. That's going to be the amount of interest that's going to be earned for our particular situation. So the journal entry, of course, would be, I'm going to write this one, it's going to be interest receivable, which you would debit for $270. And then, of course, you would credit interest revenue or interest income, however you want to do it, for $270. That's number 1. Number 2 is another notes receivable. In this case, it says the balance is $25,000. Assume the note represents funds loaned on June 1st of the current year and will be received back within 10 months. It says that the annual interest rate is 12.5%. So again, it's principal times rate times time. Principal being 25,000 times the interest rate, which is 12.5%. So in decimal form is 0.125, which I divide that by 12 to get a monthly interest rate. And then my time period in this problem is going to be what, June 1st through December 31st. So of course that's going to equal 7 months. So I'm going to multiply this by 7. And when I do that, you get around, I think it's right around $1,823. That's going to be your interest. And of course, you're going to have the exact same entry as that one, debit interest receivable and credit interest revenue. All right, so let's go to number 3, down below, number 3. Now we go to the notes payable. Now, whether it's a notes receivable or a notes payable, the way you calculate the interest is exactly the same. The only thing that's going to change is the journal entries. So on this one, it says notes payable is $15,000. That's going to be the principal. Assume that the note represents funds borrowed on September 1st of the current year and will be paid back within 6 months. Annual interest rate's 10%. So again, principal times rate times time. 15,000 is our principal. Interest rate is 10%, so I take the 0.12 and divide that by 12. And then the question is, what's our time period? So I'll write this off to the side, September 1st through December 31st. So of course, that's going to be 4 months. So multiply this by 4. Take that back. Whoops, sorry about that. Let me get back. I hit a button. Let me get back to my draw feature. Okay, sorry about that. So multiply this by 4. And of course, that's going to give you $500. Now, in this one, I'll write the entry right here. You're going to have interest expense and then credit interest payable. That would be your journal entry for $500. Okay. All right, now let me get back. Let me just click this mouse. So let me scroll down. There's one more problem on here, and that's going to be number 4. And let me just go ahead and clear the rest of the drawings. So let's check that one out. All right, so on number 4, it says notes payable is $10,000. Assume the note represents funds borrowed on August 1st and again paid back in 6 months. Annual interest rate is 12%. So again, principal times rate times time. Principal being $10,000. Interest rate is 12%, so take 0.12 divide by 12. And then this one, I'll write this one, it's August 1st through December 31st. That, of course, is going to be 5 months. So multiply this by 5. And that'll give you, again, this happens to be right at $500. Journal entry, the same as number 3. I'll write it out here. You're going to have interest expense debit for 500. It's not writing it out very well there. And then you're going to credit your interest payable for $500.